Hi there, Mark Bailey from Mark Bailey Consulting, and today I wanted to put together a quick video on a post I saw on Facebook, and the post is all about advice and queries for UK startups and businesses. I'll give you a brief overview of the post, and I'll put it on the video so you can see it. Is that someone is looking for an investor for an already established scaffolding business, and they're looking for 25 grand to invest in a new lorry and materials. As usual with a lot of these posts, there's not huge amounts of detail. There's a couple of people have obviously recommended the why don't you lease it, why do you need the 25k to put money in there, and they've come back with, well, they see it as dead money and they don't want to pay the lease repayments, which I sort of understand really from initial startup point of view. And with these posts, obviously we'll have to presume some of the obvious as well. So they're now a limited company, therefore they're established. We'll make some assumptions because there's not huge amounts of detail here. And with that one, I tend to think that established companies are more 10 years old, they've been around for quite a few years. If you've only just become a limited company, I'm guessing that they're maybe 1 to 3 years in their infancy. So I actually invest in micro businesses and SMEs. I love that area of the market because you actually see the difference you can make in people's lives. If you're dealing with a very sort of corporate world, you don't see the faces of the actual shareholders. I like working with directors and the shareholders to give more value to their businesses. Before I tell you as an investor why I personally wouldn't invest my money into this sort of business looking to buy plant and machinery, let's just look at one really good thing that this person's trying to do in their business. And I didn't realize this until a couple of years after I was in business, that actually they're trying to use someone else's money to buy a depreciating asset. If we look at when you spend money in your business, you can either use your own cash or someone else's cash. If you're using your own cash, invest it into opportunities where they'll appreciate. So, for instance, a building where you can get rent off of that asset. The actual asset is going to appreciate over time. Therefore, it's an investment. If you want to buy a depreciating asset, which a lorry, a van, a car, and it's going to go down over time, use someone else's cash. Because unless you're extremely cash rich and can do it, which not many businesses and especially micro SMEs are in, is if you use someone else's cash, they are potentially taking the risk of that asset depreciating and not getting the money at the end of it. So it's a lot less risky. And if you do see out the lease or the payments, whatever you want to see, at the end of it, you can give it back and you're not always going to take the depreciation hit, you're just taking the interest hit. So actually there's something really good this person's doing. They're trying to use someone else's cash to buy a depreciating asset. So why would I, as an investor, not invest in a business which is just going to use my money to buy plant and machinery? And if it was my business itself, why would I not do it? Well, first of all, there's companies out there which will do like hire purchase agreements where you pay a slightly higher rate of interest, like bigger deposits, but you'll own the actual lorry at the end. That's probably going to be a better route rather if you really want to own that asset at the end. Them companies will give you probably a better rate of interest than a private investor is going to give you, especially as a private investor will probably want shares back for their investment. Generally, that's how private investment works. You get money for your shares. And obviously, if you've ever seen Dragon's Den, you'll very much see the valuations which are part of that. Now, that's the second point, is actually, if you've got a company and you want, say, 25,000, and let's use nice round numbers to keep it simple, you want 25,000, you can give away 10% of your shares. So therefore, you value your business at 250,000. What happens fast forward 5 years' time, potentially 10 years' time, you've built that business and it's now 10 times the size and it's now valued at 2.5 million. Well, actually, as an investor, I'm doing okay, great, because now my shares were worth 25,000. They're now worth 250,000. But from your point of view, as a business owner point of view, you've just taken a business, increased the value, therefore that lorry you wanted for 25,000 is now just cost you 250,000 because the shares are worth so much more, plus all the dividends you would have paid in between each year when you would have paid yourself dividends, you're going to have to pay that investor as well. Whereas you could go to a hire purchase company, pay the interest rate, which I appreciate is slightly higher at the minute, maybe 8-9%, whatever that will be. And then that's it. There's no further payments except from the ones in that finance and credit agreement. Now, the other reason why I potentially wouldn't want to get private equity to fund this sort of purchase is actually going forward, you might need a credit line from somewhere else. What do I mean? Well, if you have a big project come up or a really big opportunity, say that your competitor down the road, they're looking to retire, and all of a sudden you could potentially buy their business. Now, you could go to a standard bank and hopefully probably quite a drawn out conversation and process. You might end up having that money, or you could get that cash injection via private equity and use that money to really grow your business going forward. So private equity money I'd keep for opportunities where you can see growth. And that's actually somewhere I would put my money in. So if I was looking to invest into a micro business or an SME, I would want to see my money being put to use of growing the business, not through just purchasing assets of business. So that could be marketing, that could be buying competitors, that could be opportunities they've spotted in their marketplace their competitors haven't. I'd be looking to see how they're going to grow, coming back to the share allocation and the share appreciation, how they're going to grow the value of my shares in their business. So I wouldn't be looking for someone to invest in my money in a depreciation asset, which potentially over the next 5 years isn't going to be worth nothing at the end of it. Now, there's one other thing I just wanted to put on the end of this video, which is quite important, especially for SMEs when they're just getting going in a couple of years of trading. Do not over leverage your business. Make sure you've done your numbers right. You've got your business plan, you've got your forecast in place. Without good numbers, a business will set itself up to fail. If you borrow too much money from everyone, guess what? The day comes, you've got to pay that back. So ensure if you're going to leverage your business, whether it's private equity or you're going to borrow it via a traditional bank or lease route, you've got the means and you've got the cash flow to pay that money back. If you haven't now, it might be time just to take the foot off the gas, or if you've got the numbers right in your business plan, push forward, but just be really aware that actually them repayments will come up at some stage. So quality accounting and finance and numbers is super important when leveraging a business to make sure you've forecasted to ensure that you've got enough cash to repay however you've borrowed that money. As always, I hope this video has been helpful and I wish you every success in your business.